Hello friends, the market rose for 4 consecutive weeks in a gravity-defying manner. In this video, I want to talk about whether the rally has legs, what the bulls' intentions are, what their actions are indicating, should you be expecting a correction, and how much more should we bank on this up move and upthrust to continue. Friends, I've been giving you statistical evidence in the last 4 weeks, and these 4 weekly videos that the thumbnails which you see on your screen, I have been giving you evidence after evidence that the bulls are attempting to come back. Now, this evidence following continues in this video, and on your screen right now is the market roundup window, which tells me that the upthrust was led by the bank Nifty because the interest rate sensitive sector, which is banking, had all the more good news to chalk up. The US dollar index, the Dixie, fell by 90 basis points, which was good because emerging markets, including India, want a weak dollar that leads to lower imported inflation. And a weak dollar firmed up gold and silver. It also firmed up oil and natural gas prices, which are a very, very small red flag here. The US dollar gained against the rupee by 43 basis points. The 10-year benchmark bond yield rose by 5 basis points to 7.30, which is a very, very small development. But the fact is that it remained below 7.5, a round number. The NSE gained 1.38% in market capitalization, which is another sigh of relief. MWPL. Now, please pay particular attention to the MWPL that I will cover in the next 5 minutes or so, because this holds the key to whether the markets are likely to go up or not. MWPL rose as usual, and the US headline indices, the Dow Jones, the Nasdaq, and the S&P 500 provided tailwinds and further boost to the Indian equity markets. On your screen right now is the US Dow Jones Industrial Average, which is showing signs of strength. It has overcome the previous significant high of 33,272. The death cross, although remains in place, the 50-day moving average is racing towards the 200-day moving average. Should it cross, it will then reverse the death cross and form what is known as the golden cross. Early days yet, but 33,272 level is a support which we need to watch in the coming days. The Nasdaq 100 technology-led index has actually closed above its 200-day moving average, which even the Dow Jones Industrial Average has managed. Now, the death cross in the Nasdaq also remains, but the 50-day moving average is attempting to rise and test the 200-day moving average. Here again, a golden cross can occur, but early days yet. What we need to watch out is whether the 12,898 level is violated on the downside. If it is, then you might see some more corrective decline, but the upthrust remains in place. The broadest of these all indices, the 3 indices, is the S&P 500 index, which has crossed its previous significant high of 4178, and the price has closed above its 200-day moving average. Death cross remains in place, but the 50-day moving average has turned higher. So the US indices are looking good. The MWPL, this holds the key to what's happening in the market. You see, the MWPL is nothing but the extent of positions that traders have taken as a component of the total exposure allowed by SEBI. The peak was reached in November 2021 at 35%. It has never gone there again. As a matter of fact, MWPL was finding it a challenge to cross even 30%. It has done so in August after 9 months. This is like the market is getting reborn. Do note how in the previous weekly videos I told you that after expiry, the MWPL tends to bottom, and you can see that in the last 5 expiry months, the MWPL has gone below 20. But in the July series expiry, the MWPL bottomed out at 21.48 and has raced to 27.16 in 1 week after expiry, which has never happened. Now, for the first time, traders have taken their overall net exposure to 30% plus after 9 months. This tells me that the two Marshmallow traders are saying, we are convinced, we are going to hold our long positions, we expect the markets to go up. This is why there is more action in the market than there is talk. Now, two Marshmallow traders are different from one Marshmallow traders. The Marshmallow theory is explained in the video in the description and in the pinned comment. You can please check that video out. Coming to the stock and index futures turnover, these are three concurrent expiries, which is August, September, and October. What we are seeing is that the index futures turnover is at a period low, 20 period low. The stock futures exposure, the turnover, is also in the lower end of that range, but better relatively speaking as compared to the index futures turnover. What's really happening is that traders who are sinking their teeth into long positions by buying and holding are enhancing their exposure, but day traders who are getting in and out of the market are not really trading that often. So two Marshmallow traders are hungry, one Marshmallow traders seem to be cautious. Now, for the basis. Basis is nothing but the premium or discount enjoyed by the future over cash, over spot. Higher basis along with higher price tells you that the rally is sustainable, and if the rally is on only price and if the basis is inverted, which means futures are trading at a discount, that rally is suspect. Here, however, the basis may have come down on a week-on-week comparative basis, but remains in the positive, which means at higher levels there is hedging and profit taking. But as long as the basis remains above zero, which is futures are trading at a premium, I think the bulls are still optimistic. Now for the advanced decline ratio, this is a ratio of the intraday traders, the one Marshmallow traders. It's come down to 1.09 as compared to 1.28 in the week prior, but it manages to hold its head above water. 1 is the level where gainers and losers are equal to each other. For 8 consecutive weeks, this advanced decline ratio has been positive. I agree that one Marshmallow traders are just about by the skin of their teeth having a small advantage. But watch this metric in real time on your trading terminal next week. We want the price and advanced decline ratio to rise together to give us a sustainable upthrust. Now, my friends, the impetus chart, which you have learned to depend and trust so much over the last 15 or 16 months. The impetus last week had shown the Nifty impetus had gained, whereas the Bank Nifty impetus had lost. I told you that the Bank Nifty will have to play catch up in order to basically relatively perform with the Nifty 50. Here what has happened is that the impetus of the Nifty has fallen faster than the Bank Nifty, and now the Bank Nifty impetus is also falling. Why? The reason is that momentum was not really all that great. Remember, the index futures turnover is at a period low of 20 weeks, which is why the impetus chart is falling. It's a very thin market. The traders who are trading intraday and squaring up their positions are not buying as much. It is the trader who's rolling over his positions to the next day who is actually collecting all the profits and going home, which is why the impetus is showing signs of decline. What can occur? The impetus can hit an all-time low and bounce again. What will it bring to you? Very high volatility. The prices will go in either direction in highly volatile manner. So this is why you need to trade light in the coming week. The LWTD, the lift weight thrust drag index that I have, it's another in-house exclusive indicator you won't find anywhere on the internet. The tutorial video is in the description and pinned comment below. The blue line is the Nifty percentage gain loss line, which has gained over the previous week, and the LWTD has finally broken above the zero line after staying below for 5 consecutive weeks. So the outlook has definitely improved on a week-on-week basis, and it seems that barring corrective declines, one should expect that falls will see buying support emerging. Now for the footprint of the 4 market participants type, I start with the FIIs. They've reduced their stock long positions very mildly, but increased their net long positions in index futures. Where DIIs are concerned, they've constantly reduced their individual stock future shorts, and they've raised their index future shorts substantially, a little over 4 times. But they tend to buy in the spot delivery segment, and which is why their futures positions are nothing but hedges of their purchases. Now for the prop traders, brokers on trades, very clued on guys. Who's buying, who's selling, these guys know it all. Now they've increased their index net short positions by 2.5 times and reduced their individual stock futures longs by almost 11,000 lots. For the retail guys who've done all the heavy lifting after the COVID-based lockdowns were imposed, their individual stock futures net longs are at a period low, staying below the 1 million lot mark for weeks on end. Their index futures short net long positions have jumped from 1,700 odd lots to 24,000 odd lots. Now, what does this tell us? It tells us that prop and retail guys, and both would come under individual category, are cautious, whereas the market is being rallied higher and pushed higher by institutional buying. It's become an institutional market right now. Now, friends, for the 4 heaviest weighted stocks in the Nifty, and some of these are also heavy weighted in the Bank Nifty, what they are doing and what they can do to the headline indices. The heaviest weighted stock is Reliance Industries with a weightage of 11.51 in the Nifty, beta 1.11, which means for every 1% intraday move in the Nifty 50, this stock will move by 1.11%. This has broken out above its previous swing high of 2,618. As long as Reliance Industries spot stays above 2,618 and continues to rise higher, the Nifty will get stronger legs to run upwards. The second highest weighted stock in the Nifty 50 is HDFC Bank with a weightage of 8.36%. Heaviest weighted in the Bank Nifty at 26.21%. So this stock not only takes the Nifty with itself, but also the Bank Nifty. The last 2 trading sessions on Thursday and Friday are showing signs of indecision, but a breakout above the 1,421 has already been confirmed by a couple of weeks of trading above this. As long as this index remains above this level, I think there's optimism for both the Nifty and the Bank Nifty. Can a corrective fall come in this index because of the last 2 trading sessions? Yes, the price is far above its 25-day exponential moving average, so a correction can come. But it's still a correction, not a reversal. Third largest weighted index stock, Infosys, 7.54% weightage, beta of 1.01, almost at par with the Nifty 50. It is yet to close its gap, which it will encounter at 1,728. Unless that happens, Infosys will continue to remain mildly under pressure. It will remain in a trading range where 1,555 needs to be watched as a support and 1,728 as a resistance. ICICI Bank, the 4th heavily weighted stock in the Nifty, 7.5% weighted, and in the Bank Nifty, 23.72% weightage, extremely heavy, has broken out with tremendous amount of display of strength. 867, which is the October high of 2021, has been overcome. Now we need to see whether the bulls manage to take ICICI sustainably above trade above the 867 levels. If not, there is ample amount of support at 836, which would make it a correction, not a reversal. So as long as these four stocks are remaining okay, the Nifty is going to be okay. Now, my friends, the bond market, consecutive declines, red candles for 5 weeks. This is telling you that the bond yields are headed lower, at least in the near term. This is precisely why I have been telling you on my social media accounts that we need to be laddering bonds. Don't wait for a round number of 8%, 8.5%, 9%, whatever. I gave you my example of 2013. I made a stupid, foolish mistake of waiting for a round number of 10% yield. In the bargain, I missed the bus at 9.10%. So, lesson learned, keep laddering. Am I saying that bond yields will not rise again? Hey, I'm not saying that. But right now, they seem to be under pressure. I will alert you on my social media accounts when I think it's time to start bottom fishing again. The bond market has a huge impact on the bank nifty and banking stocks, and let no one tell you otherwise. So if you're a banking stocks trader, please don't take your eyes off the 10-year benchmark bond yields. Friends, the bond yields done. I now come to the US dollar index, which essentially fell below its 25-day exponential moving average, surrendered 90 basis points on a week-on-week basis, falling on 4 out of 5 trading days. As you can see on the daily chart on your screen, the chart is showing lower tops and lower bottoms formation. Since the price is below its 25-day exponential moving average, which is a proxy for a month-long holding on cost of an average bull, the short-term outlook remains under pressure. Let's take a look at the weekly chart, which shows a bearish engulfing pattern, which means the bears have overpowered the bulls for now. Price remains above the 25-week exponential moving average, which is approximately 6-month holding on cost of an average bull. So the medium-term outlook still remains positive for now. A falling US dollar index is welcome for emerging markets, including India, because imported goods, especially oil and gas, become cheaper and lower imported inflation occurs. Last week, I advocated a range between 108.40 on the upside and 104.75 on the downside, which was violated because the low was 104.51, 24 basis points lower. In the coming week, I expect a range between 107.5 on the upside and 103.84 on the downside. The US dollar index done, I now come to the bank nifty, which stole the thunder from the Nifty 50. It gained 2.96% on a week-on-week basis. Rose on all 5 out of 5 trading sessions. As you can see on the daily chart on your screen, it has basically broken above the 38,759 resistance high, swing high of April. Now, the next high in line would be the 39,425 level, which is the February 2022 high. Now, for an important observation here. The fact that this is the index that has broken above its downward sloping trend line, which formed in October 2021 ahead of the Nifty 50. The price has galloped significantly. The price has run away from its 25-day exponential moving average, which is a proxy for a month-long holding on cost, and is approximately 2,000 rupees higher than that. Does that mean that a mean reversion or a slight pullback decline be possible? I think so. I think that's a very, very probable possibility. But I assure you that statistical evidence at this point in time suggests that it will be a correction and not a trend reversal. It is too premature to say that, hey, the bulls are tired, they're done and dusted, and they're going to surrender all their long positions. So, yes, a decline, a corrective decline can come, but bulls are still firmly in the driver's seat. The weekly chart tells you a big picture story. The price is significantly above its 25-week exponential moving average, which is a 6-month long holding on cost of a bull. So the medium-term outlook has definitely turned positive. We've broken out above the 38,759 previous inflection high. The price has gained on 4 consecutive weeks, and that we haven't seen in a very, very long time, not on this chart. So that tells you the extent of level of commitment that the bulls have put in. Do remember, the MWPL is at a 9-month high. In the week before last, this index was at number 5 on the most volatile list that we maintain in-house on the statistical beta front. It rose 2 notches to hit number 3 on the most volatile list. That makes trading on this index challenging because a heavyweight index being this volatile is likely to provide a little bit of a challenge to retail traders. Last week, I advocated an estimated range between 39,500 on the upside and 36,350 on the downside, which held perfectly well. In the coming week, I expect an estimated range between 40,600 on the upside and 37,475 on the downside. Do trade light on the Bank Nifty because volatility, like I said, is extremely high. This index is number 3 on our in-house statistical beta gainers list. I now come to the Nifty 50, which is the most liquid and low impact cost trading instrument on the NSE derivatives segment. It gained 1.73% on a week-on-week basis, rose on all 5 of 5 trading sessions last week. Now, unlike the Bank Nifty, as you can see on your daily chart on your screen, the index is yet to break out above its downward sloping trend line made in started plotting since October 2021. To that extent, the Bank Nifty has outperformed the Nifty 50. And this red trend line, downward sloping trend line, is currently at approximately 17,800 levels. We are not too far from there. The Nifty 50 can break out above this inflection point at any given point in time. But do remember that the impetus is lower and the one Marshmallow traders have shown lack of enthusiasm. It's the 2 Marshmallow guys who are taking the Nifty higher. The price remains above its 25-day exponential moving average and far above it, which is a month-long holding on cost of an average trader. The short-term outlook remains positive but mean reversion, which means a small pullback towards this moving average can occur any given point in time. And believe me, that can be highly volatile, which is why I call for caution. I'm not saying it's a trend reversal. I'm not saying it's the end of the bull run. All I'm saying is that a technical healthy correction can come in at any given point in time. For the weekly chart on your screen, 4 consecutive weeks of gains. You last saw that in December 2021. We are very close to the downward sloping bearish trend line like I showed you in the daily chart as well. If that trend line is overcome, the 18,115 level would be the next upside resistance for the bulls to watch out for. Friends, in the week before last, this index was number 11 on the most volatile list that we maintain in-house based on statistical beta. It remained at that level itself. So on the sweepstakes of most volatile counters, this index remains constant. Last week, I advocated an estimated range between 18,000 on the upside and 16,800 on the downside, which held perfectly well. In the coming week, I expect an estimated range between 18,275 on the upside and 17,125 on the downside. Here again, friends, trade light because volatility, statistical beta, is likely to be extremely high. Do remember, it's a 2 Marshmallow market with 1 Marshmallow traders being on the sideline. So there is a slight pull and push, which always results in high volatility. Now, friends, the last statistical evidence I bring to you is the percentage turnover of the futures versus options. If at all, traders are convinced that risk appetite is necessarily to be taken, then they take higher exposure in futures as compared to options, where options are relatively defensive. What you can see is the light blue line has run significantly higher. That is the stock options turnover as a total component of the total turnover. Olive green line is the percentage contribution by the stock futures turnover as a component of the total turnover. What we have seen is that stock futures turnover has contributed marginally higher as compared to last week's contribution, but the action was in the futures options segment, which tells me that traders are basically taking a lower risk route. I'm not surprised. We are heading towards a 4-week high. There is a little bit of skepticism, but it would help if futures turnover rose higher. Do remember the futures chart, volumes chart I shared with you. Index futures turnover volumes are at a period low. Friends, now I come to the most popular segment of this video for statistical traders who make their own systems. I give you 5 stocks that have gained on a day-on-day basis where impetus is concerned. You take small exposure, wait for large price moves, and 5 stocks that have lost the most amount of impetus on a day-on-day basis where you take big exposure, wait for small price moves. This for scalpers. This list is valid only for Tuesday, 16th August. I update this list every day on my Telegram channel and update you via WhatsApp. If you do wish to be added to the list, my description and the pinned comment below will give you the contact coordinates. So the high impetus gainers list is led by City Union Bank, followed by Indraprastha Gas, then by Mahanagar Gas, then number 4 is Motherson Sumi, number 5 Tata Chemicals, and the impetus losers list where you take big exposure, wait for small price moves is led by Tata Steel at number 1, Bajaj Finance at number 2, McDowell number 3, SBI Life number 4, Whirlpool at number 5. Friends, like I reminded you, this is valid only for Tuesday, which is 16th August. Do connect with me on my social media accounts. My contact coordinates come at the fag end of this video. I update a lot of data, very simple, extremely accurate and extremely bankable data on my social media accounts. Let's get conversation started, help each other become better traders. Friends, I draw this video to an end, not before reminding you to click like on this video if you liked what you saw. Subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put up out here. And I would love to hear from you about what you think about our work in the comments segment. Do let us know what you feel like. And help me reach out to fellow like-minded smart traders and investors like yourselves by sharing my video with your family, friends, and social media groups. Thank you for your patience in watching my video. Till we meet again in my next, this is Vijay Bhambwani signing off for now. I wish you have a very, very profitable week ahead. Bye-bye.